Welcome to Echo Trade. Today we have an interesting topic. We're talking about regime-based investing, which is a relatively new approach to investing that really started to gain traction after the 2008 financial crisis as a way to be, maybe more flexible to the prevailing market and economic conditions opposed to a static approach. And we brought on Joe Hosler from Auour Investments to kind of unpack this new approach. Joe and the team at Auour have been utilizing regime-based investing for over a decade now. They're actually recognized as one of the innovators in the space. Nobody really I think one of the first to utilize it for the retail market. So there's nobody better to talk to. So let's chat with Joe. Hey, Joe, Happy New Year. How you doing?
Happy New Year. All is great. I hope you had a good one.
Yeah, it was fantastic. So looking forward to a good 2024. So really curious to kind of hear your thoughts on regime-based investing. It's a pretty new approach. You guys have been using it for, maybe some of the one of the oldest firms to be utilizing this approach, one of the innovators in the approach. And so I'm curious, give me just the basics, out of the gates. What is regime-based investing in your eyes?
So regime-based investing is this idea that the markets go through cycles, and within those cycles, those long cycles, typically 15, 20 years, but within those cycles, there are different phases or regimes that the market can go through. And if you can understand those regimes, you can better tune the portfolios to take advantage of that information or that phase of the cycle.
Got it. So what are some of the regimes that you guys are looking at in this?
Well, yeah, maybe let's go back to the history of it. So the great financial crisis, global financial crisis, let's go back even farther than that, actually. So if you think about it, diversification has been a rule that everybody lives by, and we are definitely believers in a well-diversified portfolio. The idea of diversification is that you don't get hurt by any one asset, or that your portfolio does not get hurt when one asset declines versus another. That's a great idea in principle, but what we saw during the global financial crisis is that all assets get hit. When there's a drain of liquidity that happens within the market and people get scared, they get scared out of almost all asset classes. So that diversification, when you want it to happen or to protect you the most, doesn't help you. So based off of what was experienced after the global financial crisis, two firms, Bank of New York, Mellon, and JP Morgan Asset Management, both started this idea called regime-based investing. And they focused on helping large endowments and sovereign wealth funds on how best to think about regime-based investing, how to tune portfolios for different phases of the cycle. Their approach was to try to put the market into one of four categories, and those categories being derived from inflation expectations and economic growth expectations. So they looked at those regimes based off of the economy. Is the economy running hot? Is it slowing down? Are prices stable? Are we experiencing deflation or inflation? And that's how they defined what their different risk tolerances were, or where their positioning within portfolios would be. When we started up in 2013, we liked the idea of this regime-based investing, but we didn't like the idea of having to try to forecast economic functions.
Mm-hmm.
I think we all know that economists are horrible at forecasting, and yet in this situation, these two firms were wanting to depend upon those forecasts to define how to invest. We took a different approach. We wanted to understand risk regimes. How is the market expressing itself in their desires for taking risk or avoiding risk? Risk happens to have a lot more information into it. It's a lot more stable. If you're fearful today, you're most likely going to be fearful tomorrow, and you're most likely going to be fearful a week from now. Or if you're greedy today, you're most likely going to continue that greed for a while. So it's easier to measure. It's easier to understand in our methods, and it's a little bit more stable. So it allows you to have a better idea of what phase you're in or what regime you're in within the market. So we look at it as risk regimes. And those risk regimes somewhat tie to economic cycles, but not necessarily. So you could think about it after a big decline like the global financial crisis, people are hesitant. They have lots more cash. They're worried about the world. But then as their risk attitude changes, they start to move back into the market. They move into typically early cyclicals. So those areas that typically recover the first when the economy comes out of the market or comes out of a downturn. And so that's one phase, that early cyclical phase. And then there's the meat of the cycle where things are just what we call climbing the wall of worry, right? Everybody's still remembering what happened during the 2008 timeframe, but things are okay now. So they keep on adding more money to it. The economy continues to chug along. Employment's good. That's kind of the meat of the economic cycle. But then the later part of that cycle is when people start to get hesitant, a little bit more scared. They want to cling into those secular growth stories that should weather any economic storm. And then they start to avoid those things that are very economically sensitive. So that's another phase that the markets go through. So I'm going to go into too many of these phases, but there's distinct areas that we think we can tell by measuring different risk measures to define where you should be positioned within a portfolio, with the idea that it's not a statically diversified portfolio anymore, like has been presented over the last 40 years. It's one of still being well diversified, but trying to choose those assets that allow you to benefit by the economic phase that you're in.
So I want to go into your process of identifying those phases or those regimes as you define them. But first, I mean, tell me a little bit about what led you and the team to want to utilize this approach. And really, it's sounding like to me, and I could be off, that the primary function is really as a risk management tool to offer greater risk protection, as opposed to simply relying on static diversification. So am I right in that, in kind of what you guys utilizing it for, and then kind of what led you to this path in the first place as again an innovator utilizing this approach?
Yeah. So to give you too much information about me, when we started the firm, myself and my two partners were in our mid to late 40s. We have been successful in our business, in our careers. We have significant savings, and we were thinking about how would we want to manage our own money? How do we want to position portfolios where we want to take advantage of what the market provides you? But we understand that we get scared and the emotion can take over when the markets start to decline. So clean sheet of paper, we saw the regime-based investing research. We didn't like the economic principles. We thought we had a better way to do it. But really, it came down to this is the way that we wanted to manage our own money. And our own money is managed this way. All of our assets of the three partners, all of our invested assets are sitting within these strategies that we've made. So the idea was we wanted something that respected the long-term history of the markets, but was humble enough to know that there are periods where emotion can take over and scare you to make bad decisions at the worst time. And we wanted an analytical approach, a rigorous, disciplined approach to navigate those different phases that the markets can go through. One stat I'd give you is the idea that if you look at 6-month rolling returns of the S&P 500, S&P 500 can be viewed as the U.S. stock market or equity markets. If you look historically at the 6-month average return, or the 6-month return of the S&P 500 on a rolling basis, it is up positive 70% of the time. So 70% of the time, the market's going to be better off in 6 months than it is right now. 20% of the time, it's going to be down slightly. And what I mean by slightly is somewhere between down 0 to 10%. That's considered a normal period that people can work through. If it's only down 10%, that's kind of scary, but it's probably up still over a longer time period. About 10% of the time, historically, the markets are down greater than 10%. So 10% of the time, you could be down more than 10% on a 6-month return. And what we found is if you go back and look, that's when people make bad decisions. That is when emotion gets the best of them. They read the headlines, they're confirming the fears that they've had. The stock market's dropping by percentage points a day. And that's when when people get scared. And we are them. So how do we get around that? We try to understand what makes the market, what kind of environment are you in that would cause the market to decline by 10, 15, 20, 30%. By doing that, that's one of the regimes. And so if we start to enter a period where that regime seems to be likely, we will still be diversified, but we'll shrink our level of exposure to market, move into cash, protect some of our assets, so that when the markets get out of that regime, when they start to become more healthy, we can navigate back into the market. And that's the whole idea about this, is how to get people not to make emotionally bad decisions.
No, it makes perfect sense. It's all, you're dealing with a set strategy. But so let's go into the weeds just a little bit on that, on what the process is for identifying that regime. Whether it's, again, kind of coming into one of those 10% periods where it could be, a greater than 10% loss, or whatever different type of regime we're currently in. Is it a quantitative model that you guys are utilizing? Is it more kind of, fundamental? What's your approach to identifying the specific cycle that we're in?
Well, so, okay, as I said, we're trying to take the emotion out. That means it has to be a disciplined, rigorous, empirically based approach. So it is going to be a quantitatively based approach that we're using. It is a quantitatively based approach. So what we're looking at is what have been, when we've gone through other past down cycles, downturns that have really hurt people, and that's the Asian financial crisis, the dot-com bubble, global financial crisis, pandemic time period. When you look at all of those, there are some similar events that occur that if we're monitoring them, you start to gain an appreciation that you might be entering a bad time period. And so we're looking at momentum signals, which are really good, but they only work 2/3 of the time, meaning stocks were up today, they're most likely going to be up tomorrow. That type of signal works about 2/3 of the time. The 1/3 of the time it doesn't work, it's horrible. It kills you. So you need to be respecting momentum, but you have to blend it with more forward-looking items. And for us, that's valuation, it's credit markets, currency markets, and it's the interaction of global markets and how they all interact with each other. I'll give you one example where in 2016, end of 2015, early 2016, the oil, back then, oil was trading up to like $150 a barrel. And it was considered peak oil time. And there was a fear that we weren't going to have enough. Well, that caused, during 2015, a ton of money to be invested in oil. And oil started to drop precipitously. What we started to see were credit ratings of oil-based companies or oil-dependent companies declining, or becoming people becoming really risk-averse with the credits of those companies. And then it started to bleed into industrials, companies that were ancillary to the oil world that people started to shun. Then it happened in emerging markets, where you started to see emerging markets that were very dependent upon oil revenue starting to decline. So it started as a very what could be considered very narrow event, but started to spread across multiple geographies, multiple industries, and different asset categories. That was a very telling signal for us that something bigger was involved. It wasn't just about oil. There was some other issue that was coming about. And that caused us to move into a higher levels of cash in front of what was a very significant drawdown within the markets in the early 2016 period. That's one example of where we're sensing a large amount. We take data from around the globe every night to try to assess where people's risk tolerances are, where their risk appetite is. And based off of all that information, when it starts to change from being people thinking greed is good to then fearing greed and the markets falling down. So for us, it's about analyzing all of those through this quantitative process to put the markets into this different risk buckets that we have built.
So it's almost looking at a sentiment, analysis. So it's fascinating how you guys have put this together. So from an individual investor's perspective, how can they maybe implement this into their own portfolios potentially?
Well, so it's, again, Warren Buffett is really good about, he has one statement or one quote that we use a lot to kind of explain what we do. And his quote is, I want to be fearful when others are greedy and greedy when others are fearful. Meaning he wants to be counter trend, but he's actually not. You have to know when to be counter trend. And that's a very tough thing to do. So, it's one of those things where when it's your own money, it becomes very personal and very emotional. So relying on people that have a disciplined approach, that have navigated past cycles, or that can help you navigate those cycles while you're going through them, I think is important. To do it yourself, I'm biased. I'd say, we've tested ourselves over the last 10 years. We've done pretty well. So I think we have the right recipe.
No, and that's exactly, doing it yourself, you have to have that recipe. You have to have that strategy and the discipline to adhere to that strategy through highly emotional, periods. So, and again, like you said, we can now, with Echo Trade, Auour and Joe have 3 portfolios up on Echo Trade. We can rely on their expertise, which I've invested in one of those portfolios. So I appreciate the time, Joe. Appreciate the partnership. Look forward to seeing you next time. Have a happy New Year.
Happy New Year. Thank you so much.